Vince Lanci joins us this last week of August. He's up next. Vince, thanks for being with us.
Thanks for having me, Daniela.
Vince, and I specified the last week of August in the intro because it seems we'll be gearing up for a very exciting September. As we're speaking, gold has passed the $1,400 mark. How much of this is backed by Syria, Vince? How relevant is Syria in terms of an oil producer, and how does that translate into helping gold prices?
To encapsulate it, Syria, if you look at it from an oil perspective, you have to start from oil. That's where the unrest comes from. Syria is not a big producer of oil, if it is a net exporter of oil at all these days. The problem in Syria is the fear that whatever's going on there will spread like a virus, or the opposite of green shoots. And in fact, there is some deterioration in other countries, Iraq namely one of them. And the reason the deterioration is a fear and is a reality is because within Syria, you have a sectarian issue, Sunni versus Shiite, secular versus religious, and that causes lines to be drawn in other countries. So, half of Iraq supports one half of Syria, the other half of Iraq supports the other half. So Syria may mean nothing as an oil country, but Syria certainly can militarize other countries that do have a lot of oil. So the price of oil is reflecting that. And you could make the case, although I would not strongly make the case, that gold is reflecting that as well.
So if we pull up the daily chart now, Vince, how much of gold's recent rally is really due to the Syrian conflict? Is it safe haven demand, or are we just seeing short covering, Vince?
Well, if you look at the daily chart and tie it in with what's going on in the world, the rally off the lows was when the market had net speculative shorts in the market. So let's forget about the world events and let's just look at the cash flows in and out of gold. Cumulative traders showed net shorts on the speculative side. That means the market was oversold. Now, what is that number? I don't know. You have to have your own analysis. But when the market has too many shorts in it, too many people on one side of the boat without an exit strategy, when one person runs to the other side of the boat, they all do, and it just all tips the other way. So that gets your rally going. Then, through marketing, as one of the reports I read, marketeering, which I'd be happy to talk about if you like, you start to get momentum towards, hey, the shorts have covered, now maybe we can get people to get long as they extrapolate a trend higher. So to answer your question, if you were to tell me that gold has rallied because of Syria, I would say to you, I give you a 5% factor on that. The rest is after the fact marketing and hype.
And we'll get to the marketeers in a second, Vince. We'll talk backwardation, a follow-up to our conversation last week. But before we get off Syria, I know I might be comparing apples to oranges here, but if we compare it to the European crisis, so if I look at the European crisis versus tensions in the Middle East, how does gold act differently when there's an economic crisis versus political tensions?
Yeah, well, just to define gold in using one definition as a store of value, not a flight to safety or a flight to quality. It's a store of value. The question that I've asked myself and you've asked me is, why would gold react more to a European crisis than to, say, a potential military conflict? And my answer is twofold. One, we've had Middle East problems for the last 50 years. So it's kind of a tired reason for gold to rally. People kind of get numb to it. But the European thing was new. It was a potential breakup of a monetary union, and it would have been more catastrophic than in terms of ruining lives, other than a death toll, obviously, than a Syrian rebel uprising. So to answer your question straight up, the European crisis was new, caught a lot of people off guard, and involved mistrust. And gold, historically, aside from being a store of value, is a proxy on the mistrust of governments. And people thought the European governments were lying, they wouldn't get out of it. So gold and the dollar benefited greatly. So that's the new reason to buy gold. When you move to the Middle East, sure, that could be a reason to buy gold. But if you're bullish on gold because of the Middle East, you should be buying oil. You shouldn't be buying gold. That's the thing that moves more.
Vince, I'd like to now revisit a topic we spoke about last week, backwardation. Jeff Christian, the managing director for CPM Group, released a market commentary, which is available on Kitco.com for viewers and readers who are interested, that basically challenges backwardation and questions its significance. What do you think of what was written here?
Well, I think what I said last week, and I'll reiterate again, is that it exists. You can't ignore it. It rarely happens. I think. Well, let me just address what CPM said. He's right. Most of the time, when you have people's money in bank accounts and you need to put them into something, it's the marketers that create the interest, to get people into an investment. So if you're a bank with that type of a product and you can't run a commercial, basically the marketers are the advertisement. Invest your money in gold, there's unrest in the Middle East. Invest your money in gold, there's backwardation. Research reports, I think, are generally have a conflict involved in them. They're not objective because they serve the revenue side of the bank or any bank. So, Jeffrey's spot on. The problem is when you look at his report, and this is not a problem of his, the problem is if you're a gold bull and you look at his report, you read the first 3 paragraphs and you say, I don't agree, he's full of it, and then you don't read the numbers. If you read the numbers, you will see that although there could be arguments against what he says, that he makes a solid case that there's plenty of gold around. And to that point, there's plenty of gold around. It's not like the gold that's leaving the Comex vaults is being eaten. It's going to another vault. Just somebody's buying it and transferring it. So the gold's there.
So Vince, you agree with CPM Group?
No, I absolutely agree with it. But I would like to add a caveat, and it's not a contradiction to what he's saying at all. And the caveat is that sometimes hyped prophecies are self-fulfilling. And sometimes these marketers get their way. More often than not, they get their way, especially when it's behind a big name bank. And, while that is more common on marketing prowess, prices go up nonetheless. Looking down. All right. The fact remains that a tiny backwardation is not being stepped on by the banks. So either you believe the hype and you go with it, or you don't believe the hype and you wait for your opportunity to sell it. So, before I get into how I would play it from either side, it's important to put a little historical perspective on this. The last time we had backwardation, to my memory, in gold was in 1999 during the Y2K crisis. Now, it's important to understand the reason that this happened. We had a slight backwardation in gold, and that backwardation existed because everyone was worried that computers would shut down and that central banks, as a result, would pull their gold off the loaned market. So if central banks did that, then we had a little backwardation as a result. And sure enough, as soon as the computers worked on the January 2nd, that backwardation got slammed. So historically, it's hype. It's either it's pushed and marketed hype or it's not hype that's facilitated by banks, but sometimes it lasts longer than it should. So I would just say if you're a trader, you can play this from the long side and still not be disagreeing with Jeffrey Christian.
So how would you play the rally, Vince?
Well, if backwardation is your reason for getting long, and that's the reason you think is underpinning the market, the rally, you want to play the long side like you're walking into a party and you're mingling and you're just visiting, but you never take your eye off the exit because these things end, to mix the metaphor, like musical chairs and music stopping. You want to be able to get out of that door as soon as you can. This is something that can just end with a thud. It's not, if it's hyped, if Jeffrey's right and it's hyped, it ends with a thud. It ends with it's just made up. If Jeffrey's wrong and it's not hyped, it's still going to end with a thud, but it'll end with a thud maybe 6 months from now. If you don't believe at all, then you're more of a fundamentalist. And then you've got to be careful because while you're shorting the market, you've got to keep a lot of powder dry because markets can remain irrationally infinitely longer than you can remain liquid. So it's tough to play from either way. You have to be nimble. That's my analysis.
So keep your eyes on that exit sign, Vince. We're going to pull up a graph now because how do you keep from losing? I
sent you a graphic, and what this represents is based on the questions that you were given. I sent you a graphic that shows the mechanics of how backwardation occurs, and we're going to use the smart guy and the dumb guy. The smart guy is someone else, and the dumb guy at the table is me. So there are two trades that go down, not necessarily simultaneously.
So for the purpose of the example, I'm the smart one.
We'll put seller / Daniela. So on Globex, the electronic platform for Comex and NYMEX and CME, I am a buyer of gold at the price of $1,200. This is when we're near the lows and people are freaking out. And someone is selling it to me. So I am buying a futures contract at $1,200. Now, right after I buy that, and because I'm liquid, I have a decent balance sheet, I see in Hong Kong, someone is buying gold, or on the LME, I should say, actually, someone is buying gold at $1,250 physical. And I say, well, that's absurd. Physical gold should not be trading over futures. And I say, fine. And I, on the London exchange, sell unknowingly to you, Daniela, right? You don't have to be on both sides of the transaction. But for this one, let's put you on both sides. So I sell to you, you buy from me at $1,250, and you sell to me at $1,200. Seemingly a very bad trade for you. The problem is you have a multi-billion-dollar balance sheet, and I'm trading off on my Visa and MasterCard. So what ends up happening is I have a position that I need to either arbitrage and get out of very soon because I borrow at 20% interest rates and you borrow at 0, or I have to take delivery of gold or make delivery of gold, which I don't have the cash to buy. So either the market works itself out efficiently or it doesn't. So I have a decision to make. Like we were talking just now about the exits, I have to know what my exits are the moment I put the trade on. And in the second document I gave you, that shows you the exits and what my choices are and how, failing to find those exits, I end up losing money on the trade and backwardation exists.
Vince, before I let you go, will you be watching the Asian markets closely Sunday night? We have American and Canadian markets closed on Monday due to Labor Day.
I would say this. If an event occurred, the Asian markets are thinly traded compared to the U.S. and London markets, but not as thin as they used to be. But that said, I would look for sleepy, but if there's an event, forget about it. If there is a Middle East event, if for some reason we can't control events out of our time zone, you would see a spike or a dump in gold and oil. I would absolutely say if you're a short-term trader, you want to go into this holiday weekend flat.
Vince, thanks so much for your thoughts this week. It's a lot to digest. I'm sure I'll be rewatching this episode for sure. Thank you so much.
Sure. I appreciate it. Thank you very much.
And thanks for watching this edition of Reset. You can email us at newsfeedback@kitco.com or follow me on Twitter at Daniela Camboni. Thanks for watching.